Welcome to This Explainer. Today, we're investigating a massive market mystery that has traders, economists, and everyday investors totally scratching their heads. You know, for decades, the financial playbook has had this one absolute golden rule. When inflation runs hot and the value of your paper money starts burning away, gold is supposed to soar. Historically, it's the ultimate anchor, because unlike regular fiat currency, you can't just print more gold. Generations of investors have relied on this exact logic to protect their wealth during economic storms. So if we're living through some of the absolute most stubborn inflation in recent memory, why in the world is gold suddenly falling? Today we're breaking down exactly what's happening behind the scenes of the global economy. We're going to strip away the noise, look directly at the data, and make sense of this huge paradox.
What happens next could honestly surprise everyone, because the disconnect we're seeing right now is creating some genuine confusion. Just imagine checking your portfolio today. You're seeing flashing red alerts across the market. You've got high inflation headlines dominating the news every single morning, and you're definitely feeling the squeeze in your own wallet. And yet the price chart for gold, the one asset that's supposed to be your bulletproof vest in this exact scenario, is pointing in the exact opposite direction of what every traditional economics textbook predicts. To understand why this is happening and why the old rules suddenly seem totally broken, we need to completely rethink how different economic forces actually compete for your money in the modern era.
Section 1. The Inflation Mystery. When the rules break.
So let's start with the core of the problem, where inflation remains a massive daily concern for all of us. We aren't just talking about abstract numbers on a screen here. We're talking about families paying noticeably higher prices every single week for basic groceries, or pumping much more expensive gas into their cars. The Consumer Price Index proves this pain is real, and it's incredibly persistent. Now, traditionally, gold acts as the ultimate financial shield against this kind of economic fire. Historically, it's the bunker investors run to when their purchasing power is under attack. But today, that shield seems to be melting. Gold prices are dropping despite those very real inflation fires burning through consumer wallets. A lot of investors confidently park their wealth in gold, totally expecting it to rise to the occasion. But the current reality is the exact opposite. So who or what is breaking the rules? Moving on to Section 2, the mastermind, why gold is falling.
Okay, it's time to uncover the real economic drivers actively pulling money away from gold right now. It's not some glitch in the matrix, it's a very deliberate shift in how capital is flowing across the globe, and it's driven by four main culprits. First, higher interest rates, which fundamentally change the math of investing. Second, a significantly stronger US dollar. Third, delayed Federal Reserve rate cuts. And fourth, which is really just the natural consequence of the first three, investors aggressively shifting to interest-bearing assets. Think about this from a pure wealth-building perspective. Gold is a zero-yield asset. It just kind of sits there in a dark vault collecting dust. It doesn't pay you a dividend, and it certainly doesn't write you a monthly interest check. Holding zero-yield gold is practically like stuffing cash under a mattress and just hoping it magically multiplies. Spoiler alert, it won't. Right now, instead of flocking to a safe vault, investors are giving their money a paying job. They're shifting capital into bond markets and interest-bearing assets that are highly lucrative right now, all thanks to those rising rates and a surging dollar.
It really all comes down to opportunity cost. When you pit a 0% yield from a gold bar against the sheer lucrative muscle of a strong US dollar and high government bond rates, the choice for massive institutional investors becomes a total no-brainer. Think about it. If you're managing billions of dollars, why would you hold an asset that pays you absolutely nothing when you can buy a government bond that guarantees a strong, high, and virtually risk-free return? The opportunity cost, literally the money you're leaving on the table by choosing gold over bonds, is just way too high for many investors right now. Capital always flows to where it's treated best, and right now, yield is king.
Which brings us to Section 3, the Fed connection, the true mastermind.
So, the absolutely crucial point here is understanding how the Federal Reserve actually controls this entire mechanism. You really can't understand the price of gold without understanding the building where the interest rate decisions are made. Just a short time ago, the markets fully expected rapid rate cuts. Investors practically priced them in as a sure thing, betting that the whole inflation fight was basically over. But then, recent economic reports and sticky inflation changed the game entirely. And when we say sticky inflation, think of things like rent, car insurance, or eating out, prices that quickly shoot up but are notoriously stubborn about coming back down. Because of the sticky data, the Fed has been forced to delay those anticipated rate cuts to keep fighting inflation. And the current impact? Gold prices drop. It's a direct domino effect. Every single time the Fed pushes back a rate cut, the dollar stays strong, interest rates stay high, and gold takes a direct hit.
Section 4. The Investor's Dashboard, what smart investors are watching.
All right, now that we know who is driving the market and why the rules seem broken, let's equip you with the exact clues that smart, institutional investors are tracking on their screens right now. I highly recommend you keep this mental dashboard handy. First up, ongoing inflation data. This tells us if those sticky prices are finally cooling off or if they're remaining stubborn, which dictates the Fed's next move. Second, interest rates. Like we just discussed, rates dictate asset yields and the entire opportunity cost of holding gold. Third is dollar strength, which acts almost like a seesaw with gold. Generally speaking, when the dollar goes up, gold gets pushed down. And fourth, central bank purchases. Now here is a fascinating twist. While everyday investors might be dumping gold to chase those high interest rates, foreign central banks are quietly stockpiling it by the ton. This massive, quiet demand from global central banks is creating a crucial floor for the price, basically preventing it from completely collapsing.
And finally, Section 5, the verdict. 3 future scenarios.
We've mapped out potential paths forward based on all the data we've covered today, so you can stay ahead of the global economy no matter what happens next. The future really relies on 3 distinct branching paths. Path 1, if the Federal Reserve delays cuts even further to fight stubborn prices, expect the dollar to flex its muscles and gold to face continued downward pressure. But Path 2, if inflation cools faster than expected, the narrative flips. That would give the Fed the green light to finally cut rates, which would weaken the dollar and suddenly make zero-yield gold look a whole lot more attractive again. Or we could see a third scenario where gold simply resumes its long-term uptrend. Historically, regardless of short-term turbulence with interest rates, gold has a pretty solid habit of eventually finding its footing as a long-term store of value, especially if those global central banks keep quietly buying up the supply.
Ultimately, gold is caught in a massive macroeconomic tug-of-war. On one side, you have incredibly high prices at the grocery store and the gas pump, heavily pulling the desire for gold up as an inflation hedge. But on the exact opposite side, you've got the Federal Reserve pulling it right back down with the intense gravity of high interest rates. Until investors get absolute clarity on exactly when those interest rates are going to drop, gold will remain caught in this brutal tension. But make no mistake, because of these conflicting titanic forces, gold is going to remain one of the most closely watched assets in the entire world.
So based on the data you've seen today, what do you think? Is gold just taking a breather and catching its footing for a massive rally? Or are these high interest rates signaling that a much more brutal correction is coming? Keep your eyes on those dashboard metrics, watch the Fed's next move, and always keep asking the right questions. Thanks so much for joining me for this explainer, and we'll see you next time as we continue to decode the markets.